Hi, everybody. I hope all is well with everybody. I decided to post a video lesson, so we're going to do it together, and then you can fill in the guided notes that I've attached and take a picture and send them back to me, or you can do them on Google Classroom, whichever you prefer. If you don't have a printer, feel free to do it on loose leaf. That's fine. Whatever you can do is fine with me. All right, so today we're going to continue with borrowing and when to use it and when not to abuse it. So today we'll be discovering and examining the cost of credit. So we're going to start by reading the story about Jesse and his laptop, and I'll read it to you, and then you can, or if you want, you can pause the volume and just read, the video and just read it to yourself, whichever you prefer. But Jesse found a great deal on a laptop. It regularly sells for $650, but right now it's only $500. Even better, he won't have to spend his savings because the ad said he can buy it for just $10 a month. His brother reads the fine print for the store's financing program and finds the interest rate. He tells Jesse to enter 18 for the interest percentage rate and 10 for the monthly payment in an online loan payment calculator. Jesse is shocked to see that it will take him 7 years and 10 months to pay off the laptop. He will pay $431 just in interest charges, bringing the total cost of the laptop to $931. Even worse, he realizes the loan will last longer than the life of the laptop. He thinks about buying the laptop with his savings instead of using the store loan, but he decides to skip the sale and keep saving his money to buy a truck. Car dealers and stores often try to dazzle you with low monthly payments, so you'll overlook what's really important, the interest rate and the total interest you will pay. After all, asking you to pay back just $10 a month sounds much more appealing than asking you to pay 18% interest for more than 7 years. The good news is that lenders are required to tell you the annual percentage rate, which they call the APR, in writing before you sign on the dotted line. The APR is the interest rate calculated in a consistent way, so it is easier to compare the different borrowing options. It may also include fees and loan costs to give you a truer estimate of the total cost. So I'm going to ask you to pause the video, and this is on your guided notes. Which is better? Choose an option. To buy a computer and make 24 payments or 36, a stereo system and pay 13.5 or 18% interest, a lower price at a higher interest rate, delay payments for 90 days, or a truck, $1,500 cash back or no cash back. Now, with each one of these options, you may want to jot down a statement beneath it, because for some of them, it may not be so clear. Okay, so pause the video, fill in those options on your guided notes, and then you can restart the video. Okay, today we will answer these questions. How is credit used? What are the typical costs of credits? And how do I calculate the cost using credit? Use what we learned today to consider borrowing options for a specific situation. So the language of credit. Buying on credit means you are making a purchase now and promising to repay later. Principal is the cost of the item bought on credit or the amount of money borrowed. And interest is what the lender charges you for using that credit, usually a percentage of the principal. So, for example, Mariah's mom borrowed $10,000, that would be the principal, to buy a used car on credit. By the end of 3 years, she repaid the $10,000 that was borrowed, plus 3.5% interest for a total of $10,549. So again, the principal would be $10,000, and the interest rate would be 3.5%. So now we're going to read about Jesse's brother. Jesse's brother had a flat tire on his car. but he didn't have the money on hand to buy a new tire that day. He was able to purchase a new tire by arranging to repay the $150 owed, which was the principal, for the tire plus 10%, that's the interest, in 30 days. Will Jesse pay more or less for $150 for the tire? How could Jesse have avoided paying more than the cost of the tire? And on the guided notes, I've added a line of how is this different than that laptop? Because this is a different type of purchase than that laptop would be. So again, you're going to take a second, pause the video, and answer that question. Okay, so simple interest is just what it is. It's simple, and I'll explain what I mean in a minute. It's a quick way to calculate interest. First, you take the annual interest rate times by the amount borrowed, and then it's multiplied by the number of years or partial years you take it to repay it, okay? So simple interest is principal times rate times time. You should know this from algebra. We do this in algebra if you remember back into freshman year. Interest is principal times rate times time. So if you were to calculate a lump sum, let's talk about his tire. So the tire was $150, right? And then he wanted to, he had to pay a 10% interest rate. So interest as a decimal, 10%, you're going to move it two places to the left. That is times 10%. And he took it for 1/12 of a year. So in essence, a month. So each month he's going to pay how much in interest? $1.25. Okay? So that's how simple interest is calculated. Okay, now, there is times where credit, which we've discussed on numerous occasions, is very, very important. So I want you to think about what credit does for society on whole. And you can see it especially now with all that's going on in the world. None of your favorite products would exist without business having borrowed money. In other words, no company, I shouldn't say none, but mostly none, have enough money to start up with enough money to build it into an empire. That's why shows like Shark Tank and such exist, because they need more money to infuse into the business to really make it what it needs to be. So small short-term loans known as microloans help hardworking people fund businesses in low-income communities as part of a reduced poverty plan. Borrowing money in the case of an emergency, which I would have hoped you realized would be if you had a flat tire, do you really need to have it fixed? You do. So that's something, if you need that car to, let's say, get to work or get to school or whatever that car might be utilized for, that is something that is considered a need, not a want. Okay, so if you didn't have the money to fix that flat tire, would it be a great consideration to borrow it? It would, just as long as you're not paying a super high interest rate. So let's say you ruptured your appendix, or for whatever reason, God forbid, had to go to the emergency room. Would you then take out a loan? Yeah, you would. That's emergent. It's a matter of life or death. So you'd have to take out a loan and pay the interest rate. On the other hand, a lot of people buy things now without thinking about their ability to buy it, pay for it later. Okay, which is where a lot of pitfalls that people fall into. Which is why people's cars sometimes get what? They wind up getting repossessed because people buy expensive cars, and we've discussed this before as well, and then they can't pay for it. So is that a good way to use credit? Absolutely not. I agree. So if you don't need to borrow money, should you? You should not. You should not, unless you're given a 0% finance rate, which we'll discuss at a later time. So we've discussed, because you're coming to that age, very shortly you're going to be flooded with offers for car loans, for credit cards, for cash advance loans. And you should know when it's smart to utilize it and when it's smart to not. Okay, so let's talk about the rewards of credit. Excuse me. There are many reasons why people borrow money instead of paying cash. One would obviously be convenience. It's very easy to use a credit card. You don't have to go to the bank. If you're shopping online, you can't use cash. So that's very convenient. Okay, instant gratification. You don't have to save money for a long period of time. If you want something or need something, you can just go out and buy it. Protection. Very often with credit cards, they offer all kinds of protections within the credit card itself. For example, if it's damaged or lost, or one of my credit cards has, if you can find it somewhere else cheaper, they'll refund the difference, especially when you're traveling. A lot of credit cards have travel insurance and rent-a-car insurance. So there is a lot of fringe benefits to having certain credit cards. An emergency is another great example of when credit comes in handy. So again, going back to, God forbid, your appendix burst and you didn't have the money to pay the copay at the hospital, would a credit card come in handy? Positively. Spreading out payments for expensive items. So let's say even if I had the amount of money to buy whatever, when you put on a credit card, I don't necessarily have to use all that money in one lump sum. I can keep some aside and pay it off in pieces. However, there is a catch to that too, because typically you do pay a fee on that. Now, when you go to buy a house, and we've discussed this, really, I don't know anyone who has enough money to buy a home cash. So that is a time where the interest you pay is worth it. Okay, you still should shop around for the lowest rate you can get, but you're not only investing in that home and hope that that investment will in the future increase exponentially, but you're getting to live there at the same time. So you're utilizing it twice. You're utilizing it as an investment and also as housing. So that's a good time to borrow money. Investment, borrowing money to invest in a business or a property. Businesses can be risky. Properties typically are not. Throughout history, even if they go down, they come back up. Credit history. Now, we've discussed this many times about the value of your credit score and what it's utilized for. And it is important to build a credit history as long as the credit history you build is obviously a positive one, not a negative one. And lastly, special offers and perks. So there are discounts and loyalty rewards, which we've discussed. We talked about Target and how they give you 5% cash back, and Costco gives you 2% cash back, and all the coupons and all kinds of stuff that you get from various stores if you hold their credit cards. So these are a lot of reasons why you would use credit, but some of them are good reasons and some of them not so much. And you have to know which is which. So credit, as we know, makes the world go round. Okay? So this is like a flow chart of consumer spending. And it is 70% of the nation's economic growth. So right now, I don't know if you're watching the news or not, but because all businesses are shutting down and stuff, it's a big concern because consumers spend money. Then there's a higher demand for services or products. Then companies spend more money and hire more employees, and then the employees earn more money. It's cyclical. It goes around in a circle. So right now, people are not spending money. They're not going out. And if they are going out, there's really nowhere to even go. So economic growth is stunted. So a new company, when they arise, needs more equipment. They need to hire workers. They need to give more raise. That means that these people have more money, and it just keeps going and going and going. Borrowing is one way consumers can spend more when their income isn't increasing. And that can help the economy grow. But you should know that eventually what happens? So it kind of stunts the economy when you don't pay it back. So if you borrowed money from me and then don't pay me back, then I in turn don't have the money I would spend to buy whatever I wanted to buy. So it's kind of one hand washes the other on that. So I'm going to ask you to pause the video again for a minute. And I want you to think about this. If a friend offers you $100 in exchange for you paying him $120, would you say yes or no? Or would you tell him to take a hike? And if he offered you $100 now in exchange for you repaying him $20 a month for the next 6 months, would you take that $100? So I'm going to take a few minutes. I want you to pause the video. I want you to fill in the line, and I want you to tell me why you chose what you chose. So you got to pick one or the other and explain why. Okay? So I'm going to give you a second, pause the video, and please answer that question. Now, if you desperately needed that $100 right now, would you say yes? I think we all would. You'd have to, almost. Now, you almost might agree to the exchange if you could use that money to make more money. So, for example, if you were to borrow that $100 to buy video games, and you were getting them at a great deal and you knew you could resell them online, would you then give them the extra $20? I know Michael would. We all know Michael would. Otherwise, you would probably say no thanks to either of the offer above. After all, it's really the same thing. 6 months at $20 is still $120. Yet you're making a similar deal every time you get loans and credit cards. This is known as using credit or buying on credit. You're spending money that you don't have. So credit is someone is willing to loan you money, called principal, in exchange for you promise to repay that money at a later date, usually with interest. And again, interest is the amount you pay on someone else's money, and the higher the interest rate, the higher the amount you're going to have to pay back. Okay? So this is going to end today. Tomorrow we're going to get into a little bit more of the math of calculating not only simple interest, but amortized interest. And it's a little bit more complicated, but I wanted to start off slow so you wouldn't be overwhelmed. I hope all of you are well, and I hope to see you all very soon. Make sure you send me back those guarded notes or whatever notes. I just want you to answer those questions filled in. You can send them back to me via Google Docs or take a picture of your loose leaf or whatever and just upload it. Thanks so much. Take care.